usual. Well done,
Good
sir.
to see you again.
Awesome.
Nice to meet you. Oh, yeah. I have Dr. Apfel as a moderator for this panel. Do you see him coming up? Just going to give the panelists another 30 seconds here before I get started. This next discussion panel is on conducting due diligence and identifying best managers in relatively new areas of investment, such as blockchain, cannabis, and opportunity zones. In this area, in this panel, we're really going to be talking about the challenges of going into an area that's not well known by many people yet. When you're conducting due diligence and looking for a track record and a team that's been doing something for a long time, it can be challenging to do so because the whole market might be made up of relatively new players. Thanks for those of you in the corner. Just move on the way out there so we can keep it nice and quiet in here. And for this next panel, we have Dr. Apfel up here again from Sage Medic Corp., who you heard speaking earlier today. If you missed his talk for any reason, we recorded it, and it looked like you did as well, but we have that in the member portal. And at any of our events, if one of your team members wants to follow along for just one or two discussion panels and not travel to the event, you can always live stream by logging into the portal, and you'll see the live stream going there. So I'll hand it over now, Dr. Apfel, for moderation.
Thank you so much. Welcome, everybody, again. So I'm pleased that there is interest in due diligence because, as I have pointed out in my previous presentation, that's actually what it makes it or breaks it. Your return on investment basically in the early stage companies doubles if you do your homework and if you do proper due diligence. So, but without taking up too much of the time, I think it would be great if we can have our panelists to give a 1 to 2 minute overview on their backgrounds, and so that also the audience has afterwards a good idea on what kind of other questions they may want to ask. So why don't we start from the beginning with you?
Hi, everyone. My name is Ryan Zur. I have been a very active angel investor in distributed consensus systems and crowdfunding for about a decade. Most recently, I was the first fund manager at Polychain Capital and led that growth to, in 2017, the Wall Street Journal, or 2018, the Wall Street Journal published that Polychain returned 2,700% net of fees to investors. And then more recently, I've been working with the Web3 Foundation, also in the blockchain space, and allocating personal capital in the blockchain space. So yeah.
Hi, everyone. My name is Nikolai Oreshkin. I'm a managing partner of Elysium Venture Capital. I'm originally from Belarus, where I founded the first private internet service provider there. And I moved to, when the company got acquired, I moved to Silicon Valley 7 years ago, and 3 years ago was acting as a part of family office. And together with my partner from Hong Kong, we started a VC firm, which has currently slightly over 140 million under management, and invest in extraordinary founders and startup companies. And it was actually a very pleasant surprise for me to meet Fallon here, because it's the founder, extraordinary founder of one of our portfolio companies. So
we didn't coordinate before.
Yeah. Thank you.
Okay, go ahead.
My name is Fallon Fatemi. I'm the founder and CEO of Node.io. We're the first AI as a service platform that enables organizations to put the power of prediction into their applications without needing to spend millions of venture capital dollars, years, and many risky AI experiments. I am also a scout for a number of funds and due diligence for a couple of family offices as well, especially where it relates to the intersection of AI, the future of work, and I personally tried to give back to the community and capitalize on this massive arbitrage opportunity I see in investing in female-founded companies. And before that, I was the youngest employee at Google. I worked there for 6 years. This is right after IPO, so the company was 3,000 employees, grew to 30,000. I think it's now 100-something thousand. And also write in column in Forbes.
Hi, I'm Nick Hu. I'm from Taiwan, and I'm a physicist. So what I have done before, I co-founded two tech companies. It's cutting-edge technology, and now in my third company, we're doing a full 3D projector. And what I have done in those companies is that we commercialize patent technology and try to just sell it to certain industry like acquirer. And also, I have been doing angel investing since 2014 and to now. Yeah, thank you.
Hi, I'm Jake Ryan. I'm a crypto fund manager and angel investor. I too specialize in artificial intelligence. I had publications with over 600 Google Scholar citations, and yeah, so I focus in there. Thanks.
Hello, I'm Manny Fernandez. I'm an angel investor. At least that's what I'm really known for. But going back 20 years, I started off as a real estate investor in Sacramento in this area called Oak Park. I produced a 3.5 times return on a fund that we raised, a $5 million fund. And later on, I started dabbling in early stage companies, Dropbox, TaskRabbit. Currently, we are investing in this area called Oakland, and we're using a thing called Opportunity Zone. Anyone heard of that regulation? It's really doing well. So we're going to talk about that today, as well as I'm going to give you some pointers on how to do due diligence. In fact, I'm a founder of an angel group called SF Angels. It's interesting, she was a first employee. My mentor was an early investor named Bob Bozeman. He partnered with a guy named Ron Conway. They invested in this company called Google. That's who taught me how to invest way back when, because they heard about my successful track record in real estate. We're doing a little, I guess a comp course for newer angels on how to do due diligence at the St. Francis Yacht Club coming up in a month. So if you want to learn more advanced strategies, let me know.
Okay. Well, now the question is, how do we want to structure this, right? Because due diligence has many, many components. Keiretsu Forum, for example, for the early stage investments is actually often assembling a team of people with areas of domain expertise, and they often then issue such a due diligence report. This is an example that was basically done on our company, and it's an arm's length approach. And there are certain components that are really important in due diligence, and I'm wondering whether we should try to go through some of those components and what is important, what's not important, because there are, what we are usually looking at is the team, which is, and what do you do if the team doesn't have a track record in that domain? Then we look at the need of the technology. Is there a market? And what is the niche? Is there a real potential? We'll then often look at the technology, if applicable. And then we also often look at the IP and at the competition, and then how would the financial model work? Would this be an exit, and when would that exit, how would that look like, and where are the value inflection points? I'm wondering whether we should first start to ask the question about the team. That's actually the toughest to evaluate. How do you evaluate whether a founder actually has it to make it work? And perhaps the question would actually be, is it just the founder, or is it a founding team? Is he able to bring a team of high-profile individuals together? Because a successful company usually cannot be done on its own. Who would like to comment on that?
I'm happy to start. So I have both perspectives, both being a founder and also investing in other early stage companies. I think the answer is different depending on the stage that you're investing in. So if you're at the earliest stages of a venture-backed company, maybe it's a friends and family round if you get in that early, or a seed round or earlier than that. The most important, I think, attribute is in the founder themselves. Whoever is basically, you're not very easy to fire. That is the person and the attributes that that person has and the passion that they have for the mission that they're trying to accomplish. I think that's the most important piece. And I think there's two aspects to that. There's the actual founder product problem space fit. So are they actually the right person to solve the problem? Do they bring a unique perspective to the table? And then secondarily, are they going to do what it takes, even through the challenging times, to survive? Because half the battle is surviving long enough to find the 1 in a million people to make your moonshot of a vision a reality. And I'm a single founder, so I started the company, very technical company, and half the battle was, there were many times I could have given up. I never did. And I ended up hiring 2 AI luminaries that made this moonshot of a vision a reality. And now I have investors coming to me that passed early on saying, I should have believed in you, I should have written a check in you. And that's what I think is the single most important factor in an early stage company.
So I like that you started with passion, but everybody shows passion when that we are actually seriously considering, but you actually ask about the fit, whether the individual has basically the background for the problem. And I think that's another important aspect to consider.
Well, I think it goes a little bit beyond passion, right? Everyone can be passionate at times. I think it's the grit. It's that the passion is something that basically this person that's starting this company, like this is their purpose in life.
And grit is actually a nice word because there is a nice book called Success from Hendy Grant Halverson, from MBA school professor at I think Columbia University. She says that what actually makes kids, successful in school is whether they have grit. And it's actually not good to tell them whether they're smart or whether they're dumb or whatever. Not to talk about attributes of characteristics that they inherently have, because it demotivates to be active and to do something and to move forward. And what should be rewarded is the grit and the persistence and the resilience to overcome hurdles. And I think that's what you're relating to. Any else would like to add anything?
I think one of the important...
Let's see. So I'm an advisor at Mucker Capital down in LA, and so we're early stage, pre-seed a lot of the times, and so we're always looking at the product, the market, the team, and the deal. A lot of times the entrepreneurs think the product's the most important, and really a lot of times the investors really think the team is most important, and then maybe the market. And so I think being able to communicate a vision, and inspire others into action is critical. That's why being able to do a pitch really well is so important. I always like to look at who they can recruit on their board of advisors, because a lot of times, that's going to be one of their key resources early on. And then I want to be able to see that they can build systems. Can they build definable, measurable, repeatable, and continuously improvable systems? Because as they go along, that becomes really important. And I think the fourth thing is building culture. Ultimately, what's going to have teams of larger than 25 really succeeds as you start to get bigger and bigger teams is what is that culture inside. And so that's what I look at.
Great.
I think in entrepreneurs, I often look for, have they spent enough time in the space to have gotten fully up the curve? So have they sort of passed that 8,000 hours, or is the seed investment or early stage investment basically going to pay for their education in that industry? And you obviously try to avoid the latter. And in emerging industries where there aren't a lot of people who have, say, a really long track record, that's where those few individuals stand out. I'm drawing from my own experience with blockchain. The difference I find in the competency level of what we commonly refer to as the OGs, the guys who have been around since 2011, 2012, playing in the space, and the sort of recent arrivals is just enormous. And the performance of those two cohorts, as a rule of thumb, obviously there's exceptions there, but as a rule of thumb has played out that way as well.
Actually, that's also an interesting aspect, and that's the experience that people bring to the table. If you actually look at which startup companies actually succeed or which entrepreneurs succeed, we always look for the 30 under 30 or the 40 under 40s, and those exceptionally young Silicon Valley prototypes that make it to the moon. But the reality is, if you look at the statistics, the highest success rates are actually in the age of between 50 to 60 years of age. It's actually not the youngsters, because they usually lack the experience and perhaps wisdom and certain other aspects that are really important for making a business successful. So it's good to be smart, it's good to be passionate, it's good to be very resourceful, but experience in the field really matters. There was one comment that you had, and then we should move on.
So I'm going to break it down pretty simple in 2 parts. So number one, look for not just a team, but a large market and early in the market. So look for those 3 principles for the due diligence. You can screen out a lot. Is there a large market? Is it early in the team? And on the team part, there's this magical thing I would call backdoor references. For example, if she works at Google, and we know she worked at Google, who else did she work with during that time? Find 3 or 4 or 5 people within LinkedIn to have a conversation. Then you'll get a good understanding who's her character, and is she motivated all the time? Does she have bipolar? Is she great? You'll learn a lot. And I call it backdoor references because the entrepreneur does not know we do this. And this doesn't show up on any due diligence report. So think about that.
Good comment. And so that's a very important aspect. I'm not sure whether all headhunters are actually doing that. I think it's actually a very important aspect to really know who you're dealing with. I think when I'm recruiting people, I'm doing it because it's critically important. But you actually have a good lead towards the market, and I think that's one of the important things. You can often see that a big market is projected. Let's say cancer is a $100 billion market, and we are in this space. But you may actually talk about AML and a specific mutation of AML that is actually only 50 million, right? So one actually needs also to check on how realistic is this market and how big is this market. In medicine, it's relatively easy to understand how big the market is and can be. When Genomic Health came out there with their first test about 15 years ago, 12 years ago, Oncotype DX, where they could talk about the recurrence risk of a breast cancer patient that could guide them whether they need chemo or not, whether they want to go for it, or whether the recurrence risk is so low that it doesn't matter. They got, within 4 years, 60% of market share. Usually, medicine moves slowly, and many other markets move slower than one would think. But 60% of market share within 4 years is immense. And it's because of the urgent need and the number of people. And so that is one aspect for the market. And does anybody else perhaps would like to comment on the market? You didn't have.
Yeah, I'd say that the team is the most important when you validate on an early stage. But aside from passion and experience and how smart the founders, we on the first priority, we look at the leadership skills, because one of the major criteria for founders is to scale and to hire good people. And A+ founders, they attract A+ employees. And if it is a B+ founder or B-, then they attract only C-level employees. And that is very important for people not only be experienced, but also has leadership skills and ability to hire and ability to overcome any challenges that they will force.
So your argument is actually, at the end of the day, the team matters, but it matters whether the CEO or the lead management team can recruit A+ players.
Yes.
In order to have a really strong team, and they need to be A+ in order to be able to do so.
Or if they are not A+ yet, then they need to be ability to grow and also see the personal growth in the founder, because we invest in potential and high growth potential companies.
Right. The only caveat is for recruiting A+ people, you may actually need capital. So you also need to balance that with what was the available capital to recruit those folks.
Well, that is where VCs come from.
Okay. All right. Any other comments on the market?
Make sure you invest early. The key word is early. There's lots of large markets. Get in early.
Well, the one alternative sort of perspective is if you look at certain very successful pivots like Slack, they start out in a completely different market, right? So I think it's also important at the early stages, and that's where like you got to use your intuition on this stuff, but if you're obviously capitalizing more so and weighting more of your decision on the team and their leadership skills and all the other stuff these guys have said, I think that ideas would change. The path will change as they get more information and go forward. So depending on the team is what I do.
Okay. So this coming in early is actually an interesting aspect. The angel returns on investment, if you do good in due diligence, the statistics say that you have a 5.9x multiple after about 4.1 years. There are now new analysis where tech host angels actually had, on average, in a range of 5-point-something exit multiple. It's usually a little bit longer than 4 years. It's something now 5 to 6 years. So, but then you really get in early. And in order to have a really multiple, you have to get in early, otherwise you don't have the upside. If you want to invest at the time when you have all the proof as concept, you have everything lined up, and all the risks are taken care of, then it's either the company doesn't get there, or the company is already an $80 million or $200 million company. Okay. What about IP? What about competition? Anything specific to certain spaces? I mean, if we are talking here about cannabis, opportunity zones, blockchain, I think we should also consider life sciences, because for many it's actually an uncharted field. Any thoughts on that?
Generally, I would say we're starting to see the observation that the door that cannabis kicked down with respect to both liberalism on the regulatory side and also more liberalism from society's paradigms, you'll see other substances walk through. So there's a lot of excitement around different psychedelics, psilocybin, things like that, that I think will be, compelling opportunities going forward.
Yeah, I'd say that startup ecosystem is driven by money, by VCs' money, family offices' money, and VCs tends to crowd around certain topics. We can call this event many things, but let's call it trends. And the trends typically lives for 5 to 10 years. Let's say 5 years ago, frontier tech showed us opportunity in drones, AR, VR, space exploration, and so on. Nowadays, probably blockchain, marketplaces, maybe cannabis, and others. And VCs also make some mistakes, but the opportunity here is to jump on board or identify this trend before it's on a hype.
So be ahead of the curve, basically, and the advantage is that once the trend is going, it's easier also for the companies that you have invested in subsequently to raise the next round, and therefore, and capital is also important for survival and to make things work. And if you are in a space where there isn't a trend or the trend is going downwards, then you may actually be too late. Even though the company is actually performing quite nicely, it may be really hard to have a good exit.
Yes.
Okay.
Yep.
I think to get early in market trends, to be a good investor, really you want to have conviction. And so one of the hardest things to do is to get conviction early in a market cycle. And so, this is a relationship business, so building relationships, doing tons of reading. You'd be surprised how many people don't read books. I mean, just, reading books and networking with people to get conviction, I think, is the critical component you're trying to get into a market early.
When evaluating frontier tech investments, like in the AI space, which a number of us have a focus area in, what's really telling beyond the marketing, because everyone says they have AI, is actually looking at where is the monthly burn going. And if the majority of the costs are people versus technology, then there's a sign that they're probably using an old deterministic approach to AI, which will not scale, will continue to suck millions of dollars and take a lot of time, versus using cutting-edge frontier technologies within the umbrella of AI, like deep learning, which is going to also, if you were to research the trends around this kind of technology, it's going to lead to massive disruption across every industry. For example, in media. I don't know, how many people in the audience are familiar with deep fakes? It's been in the news lately. For those of you who don't know what deep fakes are, it's basically deep learning technology used for evil, where they train it on a particular piece of content or a video, and it literally can generate that content, and you don't know the difference about whether it's fake or real. So for example, my conviction on this is that it's going to, in the next 18, 20 months, the internet's going to turn into a huge magazine stand, And so, because we're not going to be able to believe it, and it's going to be especially weaponized during the election. And so I think that pockets of media outlets that are very trusted sources of information are investing in continuing to keep it high caliber and trusted are the ones that are going to kind of win. For example.
I think I can share some sort about hardware IPs. Hardware is hard, and I think the thing we are looking at is how much time do you need to really make something more mature. And actually our exit route is to make some acquisition of the tech we invested or the startup invested. Like several of my portfolios, they are life sciences, and some startups move very fast, but some of them are very slow. And I want to share my experience that you need to calculate or just do some expectation. What is the timeline for the startup to really make their deep tech, hardware especially, like mature enough to get acquired? And to my experience, like we have like 2 exit now is tech, university tech transfer IPs and got acquired. And it's within 4 or 5 years, and it's pretty good returns. Yeah, and as I mentioned, I myself, I'm working on another tech, like from technology from university, and this one is harder, but we expect like a lot more returns. I work on this on myself because I have a tech background as their CTO.
So then the next question would be around competition. Do you have any special thoughts in your areas? And could you perhaps even characterize the areas you're thinking of? Because one thing is to have a great idea. Let's say everybody moves and there is a trend towards cannabis. There are now actually 2 companies out there that are actually have developed a bacteria or yeast methods to synthesize those molecules. And so that could actually get to a level of efficiency that the agriculture projects may no longer be able to compete. It's not here yet. It may take another 5 years. But this could be competition we may not even think of. And so any thoughts of how do you evaluate competition in your field? And could you kind of say what kind of field you are in? So why don't we go through, or the other way around, from start at the end? Or if you would like to, you can also pass it, of course.
I think, so I'm looking in angel investment and blockchain space, and I have an investment thesis, and I'm looking for something really specific. I want platform business models, SaaSes, marketplaces, things that can get network effects and that can really get nonlinear growth by adding, a linear amount of people. I think you can get really great moats from that, so I'm looking specifically for those business models, and then I'm looking to apply AI specifically to scale. So a lot of people are looking for pattern matching or creating an AI product. I'm not interested in that. I'm interested in using AI to scale really fast, and so those are the things that I think create competitive advantages. This is getting more and more, I think somebody said earlier, a winner-take-all space, and so platform businesses that are disintermediating and really owning their space are important, so I'm specifically looking for that.
And in the AI space, there are areas where you can have those home runs where a winner takes all, or of that space, which you may not necessarily have in cannabis, right? So there are also different industries. In certain industries, the home run may make a big difference, that opportunity, and I think you have a strategy in mind, what you're looking for, a certain business model that sounds very, very compelling. But in other areas, it may not. There may be other aspects important when to look at competition. Who else would like to comment on that?
I think, when I see a lot of pitch decks, a lot of, different entrepreneurs and different investors have different views on a market when it's early. Sometimes when it's early, some people want to somehow greatly differentiate themselves over other people, but when it's early, sometimes that's the when to capture the market. And what we found on marketplaces looking back, the initial team really reaches out to their network, which really grows the marketplace. Like, take Angel, this is a great example. Naval had a great network, which he knew how to reach out to those relationships, and thus it grew rapidly over other companies. So if you study the founder and the founding team and figure out who their network is, if, say, they went to a certain school, they have a certain group they're a part of, that could be a competitive advantage over another startup. And doesn't mean it's a for sure thing. It just has a better likelihood than someone else.
Okay.
I think the important piece, whether it's an AI technology or workflow solution that's a little bit more intelligent, is really understanding within those different markets that you're investing in, what are the barriers to entry? So, because the reality is that the best technology doesn't always win if the barrier to entry is lower, and therefore it's much more about execution and then execution being the competitive advantage. Well, yeah, but I mean, you have to have good execution to get more resources to then continue to grow. And kick out your competitors. And we're seeing this play out in a number of spaces, I mean, especially in crowded spaces in the customer acquisition, sort of software market. There's this rise of these technologies that are analyzing the actual sales calls and then providing, sales enablement strategies for those organizations. And frankly, the technology is open source. I mean, you could build that application in 3 months. And there was and I think Redpoint bet on one company that actually built it all from scratch. And what's interesting, we're seeing play out in the market right now, is the company that had the better execution with the open source technology is the one that's winning at the moment.
Fantastic.
Even though the technology is not as superior. So.
All right. We are getting to the end of our session. We have another 5 minutes left, and I would like to open this up for the discussion so that if anybody has questions on due diligence, what's important to you, that would actually be great. Do we have a microphone around here? Perfect.
My name is hello. Yeah, my name is Raul. We have a new seed stage venture fund, and I have a split question for Fallon and for Nikolai. So you mentioned perseverance as being very important. How do you see that? And for Nikolai, the question is, how do you determine leadership potential in a first-time founder?
So to answer your question around how do you basically assess perseverance, resilience, grit, it's in understanding someone's story and understanding the career path they took and how they got the opportunities they got. So, for example, I've never applied for a job. Every job I got, I pitched myself for that role. And what did I do within those companies? Well, I learned a hell of a lot and asked for the jobs that I wanted, right? And even if I, had a challenge in a particular role, what did I do about it, right? So it just comes down to really understanding someone's motivations and what their track record has been in the past, even if they're a first-time founder, and how they look at the opportunities they've executed on in the past. I mean, I think that's a really important aspect of it. Just understanding people.
Yeah, thank you for the question. For first-time founders, you need to spend, as an investor, you need to spend more time with them. It's very important. You give a feedback. You want to be helpful. As a good investor, you always want to be helpful to founders. No matter whether you want to invest in them or pass, you want to be helpful. After you giving them feedback, you see the reaction, see how they listen, how they apply this feedback to you, and see how other team members listen to him. Because very often you invest not only in one person. One person army is like is probably too early for VCs to invest. But you look on the team and how he can settle the team from the very beginning. And I'd say that is very important.
Okay. Any other questions? Nice answers.
Fallon, just a comment really quick. You were talking about deep fakes.
Yeah.
That's just the tip of the iceberg. Because
Oh, yeah.
if you look at, remember that when you're looking at content, like Facebook as a content platform, it's junk food.
Facebook scares the shit out of me,
Exactly.
by the way. We should all be afraid of Facebook.
But the problem is that everybody's assuming that is basically the truth. And the word basically is the problem.
That is the problem.
And so it creates incredible gap, an assumption of, on some level, that it is correct, even though it's pseudoscience and half-truths, and the half-truth is a whole lie.
Oh, yeah.
Right? And so I think what you talked about is only just barely scratching the surface, and I think that it creates...
I think we should have a drink after.
I think so. And the thing is that, but it creates a massive opportunity
Yes.
in the market for exactly what you said, which is verifiable information and things
Yes.
like that.
Yeah.
So that's just really all I want to say.
Yeah, and I just use that as an example just to talk about, like, thinking about the implications of what's happening right now will help you find those markets before they happen, because then you invest in it or you give people the idea and then you back them.
I'll give you my
Fantastic.
card.
Yeah.
Any other? There are two other members who would like to comment. Good discussion.
I'm just going to keep it light here, and this is for the whole panel, and say, please share with us your most painful due diligence mistake that you made that resulted maybe in a failure of one of your investments.
A pair of very talented engineers exiting, we'll say one of the FANGs with a lot of fanfare, did a seed round and an immediate follow-on A round, and that ended up just being a complete blow-up. And so, paying a little bit too much attention to resume and not allowing the time to develop the relationship before deciding to write a larger check.
Not asking to invest in some very close friends that ended up building very successful companies that are going to go IPO in the next 2 or 3 years.
Very good. And missing out on an opportunity. So we are nearing to the end of our session.
One other one is getting the investment documents in exchange for the capital. So there's an example of a company that took the money and didn't provide the share certificates, and that's a whole other story of what happens. I don't want to break it here.
Okay.
But get the share
right.
certificates immediately.
Okay. So in conclusion, what is important for the due diligence is to look at the team, look at the opportunity, look at the individuals and the founders and what their track record is. Can they do it? Can they execute on this? And is there really a business model? Do you have competitive advantage? I think in order to really evaluate that, what my advice would be also is buddy up with other investors. Talk to one another, because nobody has domain expertise in all areas. You want to have all areas covered when you do your due diligence before you write your check. That would be kind of my advice. So thank you very much for all this great discussion. I think this was a fantastic input. Thank you.